The chart moved before the announcement. The volume appeared out of nowhere, and almost nobody noticed why. I remember staring at the XRP chart late that evening. At first glance, it didn't look dramatic. No explosive headlines, no viral tweets, just a quiet but unmistakable shift in the market structure. A few green candles, then another, then volume, the kind of volume that doesn't normally appear without a reason. What made it strange wasn't the move itself. Markets move all the time, but this time the timing felt off because nothing had happened yet. No regulatory update, no Ripple press release, no SEC filing hitting the news cycle. And yet the order books were waking up. Large buy orders appeared quietly across several exchanges, not aggressive market buys that cause immediate spikes. These were patient orders, layered, calculated, almost surgical, the kind of activity that usually comes from institutions. Retail traders didn't notice at first. Most were still focused on Bitcoin, which had been dominating headlines for weeks. XRP had been drifting sideways, trapped in a familiar pattern of skepticism and regulatory uncertainty. But beneath the surface, something was shifting. Liquidity began tightening, sell walls started disappearing, and the moment XRP pushed through a level it had struggled with for months, the market reacted, suddenly and violently. Within hours, the price surged, crypto Twitter exploded, analysts rushed to explain the breakout. Some blamed speculation, others pointed to technical patterns, but something about the story didn't line up, because when I started digging deeper into the on-chain data, the timeline didn't match the public narrative. The accumulation had started earlier, days earlier, and when I followed the flow of funds moving into certain wallets historically connected to institutional liquidity providers, the picture became even stranger. Someone had been preparing for this move, quietly, methodically, before the market realized what was happening, but the most unsettling part came a few days later. Right when the financial media expected a regulatory response, the SEC said nothing. No statement, no warning, no sudden enforcement headline, just silence. And that's when I started asking a question that very few people in the market seemed interested in answering. If banks were quietly accumulating XRP, why did the regulators suddenly go quiet? Market turning points rarely announce themselves. They happen quietly, and usually before the headlines arrive. That night, XRP wasn't supposed to be moving. The broader crypto market had been drifting sideways. Bitcoin dominance was still controlling the narrative, and most analysts had placed XRP in the wait-and-see category because of its ongoing regulatory uncertainty. But the chart told a different story. At first, it looked like normal trading noise, a small bounce from support, a few green candles climbing gradually upward. Then something unusual happened. Volume began to surge, not the chaotic kind of volume that comes from retail traders chasing momentum. This was structured volume, steady, controlled buying pressure appearing across multiple exchanges. Order books started thinning on the sell side. Liquidity above the market began disappearing. It was subtle, but experienced traders recognized the pattern quickly. Someone was accumulating, and they were doing it carefully. Large market participants rarely buy aggressively unless they want attention. Institutions prefer a different strategy. They accumulate slowly, absorbing available supply without pushing the price too quickly. The goal is simple: acquire as much of the asset as possible before the broader market realizes what's happening. And that's exactly what the XRP chart began to resemble, a slow tightening of supply. Small breakouts followed by controlled consolidation, then another push upward. Retail traders, meanwhile, were distracted. Many had already moved on to other narratives: AI stocks, Bitcoin ETFs, macroeconomic headlines. XRP had been written off more than once. But markets have a way of punishing consensus thinking, because when everyone believes nothing will happen, that's often when something begins. The real signal came when XRP broke through a resistance level that had held the price down for months. Normally, that level would trigger heavy selling. Instead, the opposite happened. The sell orders vanished, and the price kept climbing. That was the moment the chart changed. But the most important question wasn't why XRP moved, it was who started buying first. Price charts tell one story, wallet activity tells another. After the breakout began, I started looking beyond the exchanges and into on-chain data, specifically the wallets that had been quietly accumulating XRP before the move. At first, nothing seemed unusual. Thousands of transactions, small transfers between exchanges and private wallets, the typical background noise of a large crypto network. But then a pattern appeared. Several large wallets had been increasing their XRP holdings steadily over the previous week. Not massive single transactions, instead, consistent inflows. 20 million XRP here, 30 million there, then another quiet accumulation. These wallets weren't new. In fact, they had existed for years, but historically they had been linked to institutional liquidity providers, entities that facilitate large market transactions for banks, funds, and trading desks, and their behavior had changed. For months, these wallets had remained relatively inactive. Then suddenly, they woke up. The accumulation pattern was precise. Purchases happened during low volatility periods. Transactions were spaced carefully to avoid attracting attention, and the buying continued even as the market hesitated. This wasn't speculation. This looked like positioning. By the time XRP finally broke out, those wallets had already secured massive positions at lower prices. Retail traders were reacting to the move, but the institutions had already prepared for it, and that realization changed the entire narrative. Because if large financial players were accumulating XRP quietly, then they probably expected something the rest of the market hadn't seen yet. The breakout should have created excitement. Instead, it created confusion. When XRP first pushed higher, many retail traders didn't trust the move. Years of regulatory battles and stalled momentum had conditioned investors to expect sudden reversals, and that expectation created hesitation. Even as the price climbed, social media was filled with skepticism. This won't last. Another fake breakout. Whales are just setting a trap. Ironically, that skepticism helped fuel the rally, because markets move fastest when participants are emotionally divided. Some traders chased the momentum, others shorted the move, but the most powerful force was fear. Not fear of losing money, fear of missing the opportunity. As XRP pushed through multiple resistance levels, traders who had been waiting on the sidelines suddenly rushed into the market. Volume exploded, liquidations triggered across leveraged short positions, the rally accelerated, but beneath the surface, something else was happening. While retail traders debated the narrative, the same large wallets continued accumulating. They weren't chasing the price. They were absorbing supply during every temporary pullback, and that behavior suggested something critical. The move might not have been finished. A few days after the breakout, a regulatory filing quietly appeared. It didn't dominate the headlines, but for anyone following the XRP market closely, it was impossible to ignore. The filing related to ongoing legal discussions involving Ripple and regulatory oversight, part of the long-running case that had shaped XRP's entire market narrative. For years, the uncertainty surrounding the SEC lawsuit had been the primary reason institutions avoided XRP exposure. Compliance departments don't like ambiguity, but the tone of this filing felt different. Legal language suggested that certain regulatory arguments were losing momentum. Key points that once seemed central to the case were no longer being emphasized, and most importantly, there was no aggressive response from the SEC, no immediate counterargument, no sudden enforcement escalation, just procedural silence. Markets notice silence, because when regulators stop speaking as loudly as they once did, investors start asking whether the balance of power has shifted, and if that shift was real, then institutional players might have already adjusted their strategies. Large financial institutions rarely move suddenly. They move gradually, and often long before retail investors understand the full story. During the days following XRP's breakout, several indicators began suggesting that institutional interest was increasing. Liquidity providers expanded their XRP market exposure. Certain derivatives platforms saw rising open interest, and most telling of all, the volatility profile of XRP began to change. Normally, sudden rallies are followed by sharp corrections, but XRP wasn't collapsing. Instead, it was stabilizing, holding higher levels, consolidating rather than crashing. That behavior often appears when stronger hands are entering the market. Institutional money doesn't chase dramatic spikes. It prefers controlled environments where positions can be built methodically. And that's exactly what the XRP market began to resemble, a transition from speculation to positioning. Volume tells the truth markets try to hide. Price can be manipulated. Narratives can be rewritten. But sustained volume leaves evidence. As analysts studied XRP's trading data, a remarkable detail appeared. Much of the buying pressure had occurred during periods when retail participation was historically low, late-night U.S. trading hours and early Asian sessions. That timing matters. Retail traders are least active during those windows. Institutions, however, often execute large trades precisely during those periods because liquidity is thinner and competition is lower. In other words, the quietest hours of the market had become the most important, and the volume surging during those hours suggested something powerful. This wasn't just speculation, it was strategic accumulation. Financial narratives change quickly. One week an asset is ignored, the next week it's the center of attention. After XRP held its breakout levels for several days, the tone of market commentary began shifting. Analysts who once dismissed XRP started revisiting their models. Financial media cautiously acknowledged the strength of the move, and traders who had previously shorted the rally began closing positions. The narrative was flipping, but not because the fundamentals had suddenly changed. The fundamentals had likely been changing quietly for weeks. The market was simply catching up, and markets are rarely kind to those who arrive late. In financial markets, the most important events rarely happen in public. They happen quietly, before the headlines, before the explanations, before the average investor realizes something significant has begun. The XRP breakout wasn't just a price movement, it was a case study in market psychology. Retail investors waited for confirmation, institutions positioned before it arrived, and by the time the narrative changed, much of the opportunity had already been captured. This pattern isn't unique to XRP, it's a recurring theme across financial history. Smart money moves early, the public notices later, and the real question every investor eventually faces is simple. Are you reacting to the story, or are you watching the signals before the story is written?